Kia ora, I'm Paul Conway, Chief Economist here at Te Pūtea Matua, the Reserve Bank of New Zealand. This week, the Monetary Policy Committee decided to hold the official cash rate, or the OCR, at 5.5%. Over the past year or so, the New Zealand economy has developed pretty much as we expected. So core or underlying inflation pressures have come down, but headline inflation remains above our 1 to 3% target band. So there is limited room for us to tolerate higher inflation surprises in future. But capacity pressures have declined as interest rates have been high enough to slow the economy down. Overseas, higher interest rates have also contributed to lower global growth, which is expected to slow further during 2024. Now, this subdued picture will keep import price inflation down. Overall, this is all helping to slow demand for goods and services to better match the supply capacity of the New Zealand economy. In the labour market, with high immigration and weaker growth, there has been less demand for workers. As a result, labour market pressures have eased and wage growth is slowing to be more consistent with underlying productivity growth. On the other hand, very high population growth is supporting spending in the economy, and that's evident in rising home rents, for example. Ongoing wars in the Middle East, Ukraine and elsewhere, along with climate change, could also pose a risk for inflation going forward. And a recent rise in global shipping costs is one sign of this risk. But we are confident that the current level of the official cash rate is restricting demand as we continue to tap the economic brakes. But the OCR will need to stay at a restrictive level for a sustained period of time to ensure that capacity pressures and inflation expectations continue to decline and inflation returns to our 1 to 3% target band later this year. Thank you.